Thanks for tuning in today. My name's Tiffany Nolan, and I own IE Insurance. We're an independent insurance agency located in Harmony, Pennsylvania. Today, I'm here to talk to you about homeowners insurance, specifically for someone that's in the process of purchasing a home for the first time or purchasing homeowners insurance for the first time. I want to give you some information that's going to be very helpful. So what we're going to talk about today is I'm going to break down the 5 major pieces of a home insurance policy. I'm going to tell you what they are, what they do, and give you some tips and tricks as to how to buy them. Then, I'm also going to talk to you about 2 other insurance products that you may either want to purchase or be required to purchase when you're purchasing a home. So, getting right into it. First is the 5 pieces of your homeowner's insurance. Part number 1 is your dwelling coverage. This is the coverage for the actual house. So if you could imagine taking a house, picking it up, turning it upside down and shaking it, this would be everything that stays put. So we're talking about your walls, your floors, your light fixtures, all the big parts of your house. What we look at in the insurance industry is not what you pay for a house. We're actually the only people in the part of a home purchase transaction that we don't even ask. We don't care what you buy your house for. What we care about in the insurance world is what would it take to rebuild that house. So if you buy that house and a day, a week, a month, a year later, you have a complete and total loss, like a tornado comes and sucks up the whole house, we want to be able to build you that exact same house brand new. So your insurance professional is going to ask you a lot of questions about your house. That's normal. We want to know what kind of flooring you have. We want to know what your walls are like. What's the outside of your house? How many stories? Is your basement finished? We're going to use that information to calculate what it would take to build you that same house brand new today. Because we're looking at building brand new, keep in mind that it's not uncommon to purchase a house for $200,000 or $250,000 and have that rebuild cost come in at $350,000 or $400,000. That's normal. If you think about it, if you could purchase a brand new house that was built right now versus buying one that's 60, 70, 80 years old, there aren't a whole lot of people that would buy that already existing house. That's normal. That's the first part of your home insurance. The second part of your home insurance is other structures coverage. So other structures, quite simply, are structures that are on your footprint of land that you own, but they're not the actual house or attached to it. So examples of that would be sheds, sidewalks, driveways, detached garages, sometimes even swimming pools can be an other structure. Now, the state of Pennsylvania automatically gives you some protection for other structures, whether you have any or not. If you're in a typical city house or a suburban house, a lot of times that coverage is going to be just fine for you. But if you're purchasing a property that has maybe a detached garage with an apartment above it that you're going to rent out that apartment for some extra income, that default coverage that automatically comes on your insurance policy is probably not going to be enough. So if you have those extra things or you plan on adding them in the future, make sure to have that conversation with your insurance professional so that they can make sure you're properly protected. So now we've covered the second part of your homeowner's insurance policy. Let's talk about the third. This is your personal property, aka your stuff. So for anyone that's really close to the moving process, this is all of the things that you're furiously packing into boxes and trying to figure out whether you're going to pay a moving company a whole bunch of money or friends in pizza and beer to get from point A to point B where you live now versus where you're going. So there are 2 important things to remember about personal property coverage. The first thing is replacement cost. So replacement cost quite simply says that with your insurance policy, as long as you choose to replace that item, the insurance company is going to give you the money to buy it brand new. This is the opposite of how your car insurance works. When you purchase a car insurance policy and you have coverage to repair or replace your car, that's actual cash value. So if you total a 10-year-old car, your insurance company doesn't give you the money to go buy a brand new one. They give you the money to buy another 10-year-old car. And that works very well for cars because there's a nice used car market and you can buy a 10-year-old car and it works. That doesn't work so well with your stuff. So what's the value of a 10-year-old TV? It's the value of a 10-year-old just about anything in your house, right? So aside from the financial impact of not having enough coverage to actually replace the items that you lost, do you really want to go buy used socks and underwear? Probably not. That's kind of important to buy new. So that's the first thing to think about when you're looking at that homeowner's insurance policy quote. Make sure that that personal property, or contents it's sometimes called, gives you replacement cost. It will be noted right there on the proposal for you to take a look at. Second thing to remember about personal property is there are certain categories of items that have limitations of coverage on your insurance policy. For example, jewelry, artwork, guns, trading cards, stamps, collections, money. So it's important to look at that insurance policy and know what those limits are, and know that if you have more than what those limits are, you're either going to need to increase your insurance coverage so that you have the proper insurance coverage, or you're self-insuring it, meaning you didn't buy insurance, so if it's gone, you don't get any money to replace it. So don't be alarmed if an insurance professional, someone that you really don't know, is asking you about what kind of expensive stuff you have. I promise we're not looking to come case your house or anything. We just want to make sure that we're giving you the proper protection. That's the third part of your insurance, which is your personal property or contents. The fourth part of your insurance is loss of use coverage. So when you sign on the dotted line for a mortgage, which most of us are going to have, right? You're committing to making all of those mortgage payments. There's no if in that document that says as long as you can live in your house. So if you were to have an insurance claim, maybe it's severe, maybe it's a fire, maybe it's just a frozen or burst pipe that you don't have water to your house, so you can't live there until that can get fixed. Your insurance policy will provide additional living expense coverage. So this is meant to handle the costs that are above your normal monthly budget so you can still pay your mortgage. That's an important thing to think about because most people don't have 6 to 12 months of money tucked away in the bank that you can make a mortgage payment and pay rent for a short-term place to live. So your insurance company can do that for you. Now, when we talk about the loss of use coverage, here's another thing to know. Your family, the people that live in your house, may not all be two legs. Talk to your insurance professional about your pets in your household, because your insurance policy's loss of use coverage is meant to replace living for your four-legged family members in addition to the two-legged ones. We don't want you to have to leave your dog at your house with no water to come take care of them when you can't live in your house. So it's an important thing to talk to your insurance professional so that we know that you have a pet, so that we can know when you have a claim that we've got to replace a place to live that allows pets, that gives you the option for doggy daycare. Things like that are really important. The fifth part of your insurance is the first thing we're going to talk about that's not really tangible. So up until this point, we've kind of talked about your house, either it's there or it burned. Your other structures, they're good or a car ran into it. Your personal property is either in your house or it was stolen or caught on fire. You have a place to live or you don't. Liability is the intangible stuff. This is the stuff, what if someone comes to your house and they get hurt and they need their medical bills paid? Or maybe they're upset and they sue you. What do you do? So that's what your liability coverage is on your homeowner's insurance. That covers the intangible things. What if somebody gets hurt? What if something happens? So there are two pieces to liability. We've got the small scale, which is medical payments. So think of that as mini liability. You don't have to do anything wrong for that to pay. If I come to your house and I slip on a stair or trip over a carpet or maybe even trip over my own feet, that could happen. That's the little part of liability that says, hey, here, we'll pay your out-of-pocket medical costs, your copay, your coinsurance, your deductible, so that you don't have to sue that homeowner to be taken care of. That's the little part. We keep that small. Then you've got the personal liability, which is the big stuff. So personal liability handles the more major things. Someone slips and falls on ice. They hurt their back. They break a bone, fall off of a second-story deck, fall through a set of steps, get injured in your swimming pool, hot tub, or outdoor trampoline. So here's the thing to know about liability. So liability starts at $100,000. That's the minimum liability you can get on a homeowner's insurance policy. When you look at claims and how claims pay out and how much they pay out, $100,000 handles 2/3 roughly of the claims that we see in the home insurance industry. So 2/3 of the time, if you have $100,000 coverage on your policy, that's going to be okay. 97% of the time, those claims are satisfied under $300,000. So there's about 1/3 of the time that an insurance claim is going to be over that $100,000 threshold. So what do you think happens if you have that $100,000 coverage and the damages awarded to that person are $150,000? Where's that other $50,000 come from? I will tell you, I hope your pockets are fuller than mine, because if your insurance doesn't have the money to cover it, you get to do that. So I tell you this because for most homeowners, $300,000 is what we're going to recommend for that liability coverage. So you think, oh gosh, Tiffany, you're just racking up my price, right? No. The cost difference on a yearly insurance policy is usually about $35 for the whole year to go from $100,000 of coverage to $300,000 of coverage. So it's something that's a very good investment to protect your financial future. Last thing I'll say about liability coverage is there are some scenarios where liability coverage might be a little harder to find, or you might need a little more coverage. So the fancy term in insurance is attractive nuisances. The generic term is things that people like to come play on and get hurt. Swimming pools, outdoor trampolines, hot tubs, zip lines, getting newer. The insurance industry hasn't completely caught up with people having zip lines on their private property yet. But if you're going to have these things, these are things to talk to your insurance professional about because we might recommend a little bit higher liability protection for those scenarios. Second thing about homeowners insurance is pets. We talked just a minute or two ago about those four-legged family members. Well, if you have those four-legged family members, you may have a little bit more difficult time getting insurance depending on the breed of dog you have. So I've officially coined the phrase, the doggy no-no list. It is not copyrighted, so you're certainly welcome to steal it if you want to. But there are basically 7 breeds of dogs that some insurance companies are going to ask some more questions, flat out tell you no, or maybe be okay with. So if you have a dog that is a pit bull, Rottweiler, Husky, Chow Chow, Alaskan Malamute, Presa Canario, have you ever seen a Presa Canario? Search that online. That is a scary looking animal. Or a wolf breed, or any mix of any of these animals, you're going to find a lot of variance in how insurance companies handle that. There are lots of choices when it comes to homeowners insurance. In the state of Pennsylvania, there are actually 800 companies that you can buy from. That's not agents like me. So I'm an agency. We represent about 35 companies. I'm talking actual different insurance companies that can provide you insurance. So if you call the insurance professional that you're used to working with and they're like, oh my gosh, you've got a pit bull, I'm sorry, I can't take care of you. It's okay. Move on to another company. There are always options out there for you. But it's also something to think about. So we've broken down the 5 major pieces of homeowners insurance. So you kind of have an idea of what those are. There's a lot more to it, but there's a lot of personal conversation there as well. So there's one more thing about your homeowner's insurance policy that if you remember nothing else that I say in this video, here's the thing to get. Your homeowner's insurance policy is gonna have a deductible. This is the amount of money that you have to pay if you have an insurance claim. The higher the deductible you pick, the lower your insurance policy cost is. Don't take a deductible you can't afford to pay. Here's the thing. Most insurance claims are not a complete and total loss. When have you heard of a tornado sucking up a whole house? Really not very common. Most insurance claims are partial losses, meaning you have some damage and it's enough to justify using your insurance, but it's not demolishing your whole house. So for example, you have a kitchen fire. Your whole kitchen's burned. That's probably a $40,000, $45,000 claim, depending on how extensive the damage. If you opted for a $5,000 or $10,000 deductible on a $50,000 claim, we'll still pay our $45,000 or $40,000, but if you can't pay your $5,000 or $10,000, you don't have a whole house again. So don't take a deductible that's too much for you to pay. Now keep in mind, you don't need this deductible 10 minutes after you have a claim, but in the next 15 or so days, you should be prepared to have that deductible ready. Most homeowners insurance policies start at a $1,000 deductible. Some companies are going to make you start at $1,500 or $2,500. There are some companies that'll require a $5,000 deductible to start. If that doesn't work for your budgeting and planning and income, look at another option. There are choices, right? So that's your homeowner's insurance. Now, really quickly, I want to talk about two other kinds of insurance that you may want to buy or be required to buy. The first is always an option, and that is mine subsidence insurance. So I'm probably not shocking anybody that lives in Western Pennsylvania that we're a coal mining town, right? Hundreds of years ago, coal miners went in, they dug holes in the ground, they scraped out all the coal, and then they did something to seal up those mines. I don't know what that is. I'm sure someone could tell me, and I probably wouldn't understand it. Insurance is my thing, coal mining is not. But if at some point in time, whatever those miners did to seal up that mine gives way and the ground starts to collapse, mine subsidence insurance is what is going to cover rebuilding your home. It's not something that's on your homeowner's insurance. So, great news. A large portion of Pennsylvania is already mapped, meaning if there was an underground mine under the house that you own or are buying, chances are the county knows about it, the state knows about it, and you can look it up. It's not all of them. So there is a website. Mine Subsidence is the only insurance that you can buy without any insurance professional like myself helping. So I can't tell you what the website is because it's one of those .state, .pa, .us, .gov, and there's probably 4 more .somethings there. But I will tell you, if you open your favorite internet search engine and type in PA for Pennsylvania, mine, M-I-N-E, and then you don't even have to spell subsidence. You get the S-U-B in there, it'll complete it for you, and you can look at the map, you can type in the address. If it's gray, there was a mine. If it's white, there wasn't. Now you can, however, reach out to any licensed insurance professional in Pennsylvania, so such as myself and IE Insurance, and if you give us the address, we can take a look at it and give you an answer. We can also give you some indicators as to things to look out for in a home that you're potentially purchasing or already own that could be indicators of some earth movement happening. So that's always an option. Second policy you may be required to purchase is flood insurance. So in the United States, FEMA has mapped all of the properties that are already existing. So they have determined that these properties are either in a high risk or a low risk of flooding. And they've assigned a letter or a series of letters to define that. So first of all, I want to tell you what high risk is. Because when we think about risk in most of our life, we think about driving without a seatbelt. That's risky. Not wearing a helmet on a motorcycle. That's risky. Skydiving, kind of risky. High risk, when you look at flood insurance, means that there's greater than a 1% chance in any given year of experiencing a flood. Boy, that's helpful. Let's turn that into English. You might flood once in the next 100 years. So when we're looking at high risk, you have to think about what is that real risk. But if the property is deemed to be in a high risk flood zone, you are going to be required to have flood insurance for as long as you have any sort of loan on that property. Doesn't matter if it's first mortgage, a second mortgage, a home equity line of credit. If your home is collateral for any type of funding, you're required to have flood insurance. It's required by the federal government, and the federal government makes the banks show that they've obeyed that rule in order to continue to lend money. I tell you this because flood insurance is a whole different ballgame than property insurance and your homeowners. Whereas a homeowner's insurance policy is going to range between $1,000 and $1,500 a year in a lot of scenarios. I mean, there's always outliers there, but we'll use that as a ballpark. Flood insurance for a high-risk flood zone is typically going to start around $2,000 a year, and the highest I've seen is about $12,000. Now, that doesn't necessarily count because that was a commercial building, so a little different ballgame. But it's not unusual to see a flood insurance policy for $3,000 or $4,000 a year. That's a huge amount of money that either comes out of your budget or that you could have been applying to principal on your mortgage balance and paying off your house even faster. So when you're looking at a property, it's a great idea before you put in that offer on the property to know whether or not that house is in a high-risk flood zone and whether or not you'd be required to purchase flood insurance. How do you do that? Well, the government has a website for that too. It's actually easy. It's floodsmart.gov. I will say it's a government website. Good luck navigating it. Not the most user-friendly. So with us at IE Insurance, you can always reach out to us, and pretty much as fast as you can give us the property addresses for the properties that you're looking at or a property that you already own, we can usually tell you instantly whether or not that property is in a high or low risk flood zone. If you give us another 5-7 minutes, we can also tell you what that costs so that you can be prepared for that ahead of the game. So flood insurance only handles flooding. Mine subsidence only handles if the ground collapses due to an underground mine. Homeowners insurance covers a lot of everything else, but not everything. So there are a couple things that aren't covered on homeowners insurance that I just want to touch on real quick to kind of bring this back full circle. So your homeowners insurance is for sudden, accidental, and easily able to tell why things that happen. The kitchen caught on fire. A car ran into my house. A tree fell on my roof. It's not for things that are maintenance or wear and tear. So for example, my roof is shingles and it's 22 years old and it's now leaking. That's a maintenance item, not a homeowner's insurance claim. So you think about your homeowner's insurance for sudden accidental things that happen, not maintenance things or wear and tear. So some other things that are not covered on homeowner's insurance: damage caused by insects, rodents, or vermin. Your home insurance is not going to send a pest control company to get termites out of your house. You'll need to find those on your own or reach out to us. We have some recommendations for you. Your homeowner's insurance is not going to cover intentional acts. You are not allowed to burn down your house just for the purpose of us building you a new one. It's not how that works. Your home insurance isn't going to cover floods, ground collapse. Those are things that you can purchase those separate policies for. And your home insurance isn't going to cover mechanical breakdown things. That's where a home warranty comes in. So you can purchase a home warranty on your own. You can work with us. We do have a home warranty company that we work with to provide you home warranties for things like, oh, the hot water heater died. What happened to it? I don't know. It just got old. That's a home warranty thing, not a home insurance thing. The last thing I'll say is that your insurance professional needs to be someone you can communicate with. We're the people that you talk to when the worst thing happens. Your home, the biggest place you spend the most amount of your money at one time, is not okay. When you're interviewing insurance professionals to provide you homeowners insurance, please take some time to converse with those people. Because if we don't communicate well when I'm getting paid to sell you something, how are we going to do when you need me for something bad? So have the conversations with your insurance professionals, interview us. I think last check there were about 40,000 different insurance agents. So 800 companies, 40,000 people with access to those companies. There are plenty of fish in the sea. So if you're not feeling comfortable, entirely comfortable with that relationship that you have, please do yourself the favor to look somewhere else. This is the person that's going to be here for you and take care of you when the worst things happen. Thank you so much for watching today. Again, my name's Tiffany Nolan. My company's IE Insurance. We're in Harmony, Pennsylvania. And thank you so much. Bye.